All right, so but I always like to start off the show each week with a conversation about what we saw happening in the stock market this week. And so I'll share a chart here for starters. So kind of a bad week so far.
Mm-hmm.
Yesterday we had a red shirt day. So for those of you who watch my daily videos, I wear different colored shirts depending on what the market did that day. Red is for more than 1.5% down, and green is for more than 1.5% up, for example. And I just mentioned last week that it had been over 100 days since I'd wore a red shirt.
Yeah, you may have jinxed it there.
Maybe. And that goes back, it was an article I saw that went back to 2018 since that's happened the last time. So it also kind of means that, things had gone long enough before we had something like that. I mean, it's sort of like averages tend to work out. And it's kind of my theme here that's happening and that I've been talking about for a while. You can't have the types of run-up that we've had this year without some type of consolidation and pullback, in my opinion. And it's what I've been talking about really since July. And today is just kind of the same type of thing. And so, we have a lot of headwinds coming at us, but we kind of always have some headwinds, right? You can always pick out something. We have an auto union strike happening on a rolling basis. We have a possible government shutdown coming at us here at the end of the month. We've got rising oil prices, and all of these things, are feeding into this, picture of gloom, I suppose. And the Federal Reserve, of course, just had their meeting, and they're trying very hard to get the market to come down, at least with their words. And they're talking about keeping rates up for longer, and what have you too. So, having said that, when you really break everything down and you kind of take that aside, there's an awful lot of positive things happening right now. Company earnings continue to do well. The consumer continues to spend. The whole thought process of recession has now been tabled. It's amazing.
Mm-hmm.
I mean, article after article after article last year talking about recession, first half of this year, second half of this year, and that's all gone. And why is that gone? Because we're basically seeing inflation slowly but surely coming down. We're seeing the scenario where the Fed has paused now 2 out of the last 3 meetings, right? And the one meeting in between was only a 1/4 rate increase. Maybe they do it again in November, but the signs are here that things are getting a little bit better in that area. And we're at the moment we're in this kind of soft landing zone. We may not stay there. We may skyrocket upward or fall downward, but that's where we're at, and that's where we've been at for quite a while. And both Chairman Powell, the Federal Reserve Chairman, and Janet Yellen, the Treasury Secretary, have both been talking about this data that they see showing a fairly strong economy.
Mm-hmm.
We saw, this week, the first-time unemployment claims was quite low, lowest it's been in months. And so, the job market continues to be really strong, and that offsets a lot of these other bad things. And so I think that there's enough here. And then we need to look at the market as a whole and what it's trying to tell us. And so I'll show you this little line here. So at the moment, I just put a little line right where we're at. Got a little bit of support right there.
Mm-hmm.
We're bouncing a little bit today. And however, the big support is just below that, kind of 4,200. And we're at 4,300 now, kind of that 4,200 to 4,050 range. You can see a big jump of pricing in that area. And so the idea behind support is that the market spent a lot of time at one particular price, and a lot of shares were purchased at that price. And then it goes higher than that price, and people say, wow, good, I made money. I'm glad I bought it at that price. And then when it comes back down to that price, people would say to themselves, hey, I made money last time. Now it's come back here. I'm going to buy it again at this price. I'm going to buy more and accumulate at this particular price. And so that's what's causing this little bit of support we're seeing right now, most likely, right? Kind of right off of this 4,300 level. However, there's not a lot of support below that because we went straight up from basically 4,200 to 4,300 in just a few days there. And most likely, if we do come through, we'll come back down to that 4,200 range. And that's actually okay. That's part of this process. That's how this works, especially in a market where, we're still trying to figure out inflation. We're still trying to figure out what the Federal Reserve is going to do, right? And those are big issues that are happening. And so last time we had this show a couple weeks ago, I
Yep.
talked about kind of the stretch of the market, and it really revolved around a question: is how did you know, or because as you recall, in the middle of July, I started talking about the fact that the market was too stretched out. They were probably going to be heading into a consolidation period, and that's been quite true so far. And really, it had to do with kind of looking at these moving averages. So this is I just inputted the 200-day moving average on there, this blue
Hmm.
line. So every point on that line is an average of the 200 days prior, right? And so it just kind of smooths it out. And then I'll put a 50-day moving average in there. Same thing. Every point's an average of the 50 days prior. And then I'll take out the price. So I like it. I like this chart. I look at this kind of chart all the time. It just helps me, and what I'm looking at is different things. When does the 50-day crossover
Hmm.
either down through or up through the 200-day moving average? What is the 200-day moving average? Which direction is it going? So it's definitely going up. That's a really big deal. That's a lot of momentum coming upward at us. But then the other thing we look at is stretch, right? So I talked about this last week or last show, and so we got this very high stretch. There's a 7.5% differential between the 200-day moving average and the 50-day moving average. And if you look back historically, and I look at these on a percentage basis, it's pretty high,
Hmm.
right? So the market got ahead of itself. Why did it get ahead of itself? Well, we got a whole bunch of things happen at once. We were consolidating sideways there for a while because of the debt ceiling argument,
Yep.
right? And then that got resolved. At the same time it got resolved, NVIDIA came out with their quarterly earnings report, and everybody started to discover this concept of AI and how it might work and who might make money from it. And we saw this jump. And of course, once you get a little bit of jump in a market that people are doubting, because at that time there was very heavy, expectations for recession,
Hmm.
right? Well, you got a lot of people shorting the market, expecting those expectations to actually happen. And so market starts jumping upward and people have to cover those shorts. And so we get this huge run up. Well, all of those things are great, but they're not really permanent things. The
Hmm.
debt ceiling isn't going to be renegotiated again until 2025, those types of things. AI might be permanent.
Yep.
We'll see how that plays out. But for the most part, it kind of gets ahead of itself, gets stretched out, and if you look at where it is now, we're at 6.8%. So it's okay. This is what we're supposed to be doing overall. We're supposed to be kind of consolidating and bringing that stretch back down. And a lot of times you need to go down to go up.
Yeah,
Okay.
the market's emotional, so you're gonna have that greed and fear kind of cycles back and forth.
Yep. And you get down a little bit, and some people start to come in and buy. You get down, and again, I think we probably are going to get down to that 4,200. I wouldn't be surprised. It just doesn't seem like enough support where we are now, and there's enough, selling going on. But you get down to a price where people say, "Wow, okay, I'm going to take that," right? And you get people to come off the sidelines. The amount of money in money markets, I saw a thing of $5.6 trillion is sitting in money markets. Much of that has moved in during this, downturn. That can come back as things start to get better again. And, we do have a seasonality here. The low for last year was October 13th,
Hmm.
right? And so here we are, September, which is historically, on a seasonal basis, one of the softest month of the year on average. And then October is kind of a weird month. Everybody associates October with kind of the crashes because the 1929 crash, 1987 crash happened in October. However, October is actually a decent month, but again, I still think there could be some seasonality follow through here, especially with that much stretch that's happening. However, all of this just means that, at this point, until you start to fall apart, okay, 200-day moving average starts to come down. We're in a different market, right?
Yep.
Different concepts. The 50-day moving average crosses through the 200-day moving average, high down through it. That's not good either.
Nope.
We hit new lows that are lower than the previous lows. If we look back, all the lows since October have been higher and higher, right?
Hmm.
So none of those things have happened. I mean, none of them. So you have to assume at the moment we are in an upward market, and you kind of operate in that environment, and you keep that mindset until these other things do happen. New lower lows, 200-day moving average down, 50-day comes down through the 200-day moving average, etc. There's a whole bunch of pieces that we have that we look at as far as that goes. So now our signals, as a whole right now, are fairly accurate for what's been happening, right? So we are on the stock market signals. We're basically on our fast signal. We're red, and rightfully so. When we've been red for a little over a week, and the market has come down all week. So there's a little bit of momentum on short-term basis to the downside. Our slower signal is yellow, which again, that seems pretty accurate too. If you're going to have a consolidation period, this is a caution spot, because it could turn into a downturn. And so you want to be cautious. And so new money that's coming in, we're just waiting. We're holding on to it. I've got some clients that want to move up from 40% to 60% stock or something. I'm telling them to wait. And one of the things I'm waiting for is I'd like to see us break out of this consolidation zone, break out to the upside. Now, the bond market, on the other hand, is having much more difficulties. We've had double reds on the bond market, and we've been out of the bond market with a majority of our holdings for quite some time and sitting in T-bills and waiting for this to come around. The bond market is struggling with a couple of different things, actually. Number one is, of course, we're in an inflationary environment.
Yep.
And the threat of raising interest rates and the Federal Reserve talking about higher for longer and all these things are creating a problem for the pricing of the bond market. Now, the yields are good. The 10-year yield is at 4.5% now, that kind of thing. But altogether, the other thing that's happening, of course, the Federal Reserve is moving bonds off of their balance sheet. They were called quantitative tightening. It was quantitative easing when they were buying it during the pandemic, and that was making the price of bonds go up quite a bit. And so, we're watching that with interest and see how that plays out here. But for the moment, it's kind of a different story. No big stretch, no big run up there. Kind of a sideways motion all year long, right?
Yeah.
Up and down, sideways, but still sideways. And so, really interesting time frame as far as that goes. I'm still optimistic, as I should be, because right now we're in an upward market, and until we turn into a downward market, I try to keep that mindset and keep moving until we start to see some proof that we're in a different market. Because all we're doing right now is making a sideways consolidation move, and there's nothing wrong with that. I think that's actually very healthy. That's what will allow us to get back up to these new all-time highs as far as that goes. Okay, so anyway, that's what's going on this week. I know it's not a great week, but it's not a bad week either, in the sense that this is what a healthy market does. It has these consolidation periods. Again, that could turn into a downturn, and we'll react to that, but it hasn't yet. And so let's just keep watching it and see where it goes. But at the moment, it's just going sideways altogether as far as that goes. So let's see how this plays out, and look forward to, again, discussing this again next week.